So welcome everyone. Today we have Mr. Sridharan again. I'm sure all of you know him, but I will be giving an introduction for the newcomers here. So today it'll be retirement at risk. Why must you regularly check and adjust your portfolio? It is such an important topic, especially for us seniors, where we everything is like it's like fixed, right? I mean, unless we have the income coming in, we need to know how to actually check, adjust to grow our portfolio. Okay, so this is an important session. And in case you would like one of your friends to join, please ask us for the link, or if you have the link, please pass it on so everyone else also can come and benefit by this session. Yeah, the next one. So the what are you going to get from today's session is you can shield your savings from inflation because neglecting to adjust your portfolio can devastate your savings, making it impossible to keep up with rising living costs. As you all know, with all our finance session, we all know how because of inflation you have to do the adjustments in order to stay on top of everything, the finances rather. Defend against market crashes. Failing to regularly review your investment can lead to catastrophic losses during market downturns, putting your financial security at a grave risk. Brace for unforeseen expenses. Now, this is very important because we all have unforeseen expenses and a big, hefty sum sometimes coming up. So, you need to be ready for that. Ignoring potential future costs like medical emergencies can leave you dangerously exposed and financially unprepared when the disaster strikes. So, this is a very important session that will cover all this and more, so please hang on, stay in there to learn more about it. Okay, next slide. Next slide, Tina. Yeah. So a little bit about Get Set Up for all you newcomers here. Yeah, we are a very happy senior group and we are on a mission to help those above 55 learn new skills, connect with each other, unlock new life experiences. And trust me, we do all of them with a passion. Our goal is to reduce isolation, loneliness, and equip you with the tools and knowledge to age independently and in place. Yes, we do. We have all the fun things going on the website. So please do join us. In case you are wondering what is it exactly you do, just download the app and just check it out. We are on full swing with passion right from the morning 7 o'clock. Okay, we have everything from wellness to yoga, dance, music. So you choose and pick whatever it is that interests you, and you can join us. Our community engages in classes online as well offline activities also, and we also travel together. So we have it all packaged into one package deal where you can not only get to learn things online, but you can also get to do things offline. And yes, you can also travel together, make great friends, and enjoy your retirement life, which we all are doing right now. Yes. And next slide, please. Okay, so a little bit about Franklin Templeton. As you all know, I'm sure we've had Franklin Templeton classes before as well. They are one of the largest asset managers globally with over 76 years of experience and currently managing assets to the tune of 1.63 trillion USD as of 31st May 2024. It has been part of the Indian mutual funds industry for over 28 years and currently manages assets for about in INR 88,000 crores as of March 31st. Franklin Templeton India offers a diversified bouquet of products spanning equity, debt, hybrid, and international funds, which can help to meet various financial goals of investors. They have a rich history of being pioneers in many ways, like introducing the concept of SIPs in the Indian mutual fund industry. Their global parentage and local market expertise position them uniquely in delivering value to investors. Next slide, please. Now, today is Mr. Sridharan. I'm sure most of you, or rather all of you, know him, but I would like to introduce him once again. Mr. Sridharan is a recipient of Associate Financial Planner title for retirement planning and employee benefits from the Financial Planning Standard Board. So he is absolutely qualified and the best person for you to listen to today and also clear your doubts. He's an active contributor on personal finance magazines like moneycontrol.com, Financial Express, Times of India, UTI, Swatantra, Nayanam, etc. He's worked with Funds India, Quantum, Allegro Capital. He has 15 years. He was 15 years with independent as a independent financial advisor. He has conducted regular sessions on the retirement planning across all major PSU banks, which include IOB, BOI, Indian Bank, etc. So do post your questions on the chat. We will take it towards the end. I do have some questions which we have, which the members have sent us as well. Okay, we will be taking questions towards the end. Please post it on the chat. Thank you very much. I'm handing it over to Mr. Sridharan.
Thank you for your introduction, Anita. See, basically, we are talking about the retirement. See, basically, this 10-letter word, retirement, everybody is feeling kind of, what do you call, the boring word called retirement because, they don't know what to do after retirement, especially when it comes to money. So making money is the first job, and saving money is the second toughest job everybody has in their hands. So when we are talking about managing the retirement, the first and foremost thing one has to do is there are people who wanted to retire early, might be at the age of 55. Some of them would like to retire at the age of 50, or some might be in the real retirement age of 60, or some of them might be even working after 60 for money. See, idea is first and foremost, you have to identify what is the need. What is the identify this is the number crunch game. So we will have to identify what is my needs are. My needs are basically, I have to run a simple, lifestyle. For that, yes, this is the, kind of amount that is required to manage my retirement. Retirement in the sense, basically, we all retire at the age of 55 or 60, but the life expectancy goes until 85 or 90 years. For a very healthy, a male and a female, nowadays, they are all living until 85, 90 years. So when we are talking about more than the work life, the retirement life is prolonging. I put forth the question of assuming, if you are living beyond 100, if I live 200 years, what is that I'm going to do? This is where actually, everybody is curious about it. The reason being, one is basically one thing which they are not very clear about is how much money that is required to ensure that the inflation is not eating away the corpus. So one is identify the value that is required today, and secondly, what could be the inflation? Because the inflation is the is the enemy for your money. Inflation is the basic. There are inflation is the enemy, and taxes are the two enemies that are there for money. So when we are talking about you need, let's say, about 50,000 rupees today, 5 years later, when we are talking about 7% is the general inflation that works on household expenses. So when we are talking about household expenses is 7%, this 50,000 rupees after 5 years, it may be probably, becomes maybe about 75,000 or 80,000 rupees. So this is where actually, you have to identify even after retirement. When we are retiring at 60, when you wanted to live until 75 or 80, the rest of the years also, the inflation will eat away your money. So we need to identify what is my needs. Secondly, you need to identify to sustain my lifestyle post retirement. What is the purpose that is required, which will probably provide me a cash flow and that will adjust my cost after inflation. So this is something, one has to identify to ensure that the corpus that you have accumulated will be sufficient for your retirement. So when we are talking about inflation, there are plenty of products that are available in the market. There are products, when we are talking about the products, there are products available, like, there are, there are various products. That is, fixed income products are available, like, your fixed deposits or corporate fixed deposits, or, your annuities. So these are the fixed income products that are available. And on the other side, if you look at it, there are equity based products that are available. Then gold is something that is available. Then property. So these are the four major asset classes. One is the fixed income, second is gold, third is properties, and fourth is, your equity and equity based product. What is the risk associated with each of this product? Yes, there are risks that are associated with each of these products. So when we are talking about fixed income, fixed income products, basically, what is the risk associated with fixed income products? Or basically, the fixed income products are providing you a return which is lesser than the inflation. Assuming if the inflation is 7%, you are getting from your fixed deposit, 6% or 7%. After adjusting the taxes, your net income that you receive is basically only 4.9%. So when you are getting an income of 5% and the inflation is 7%, capital erosion is happening without even you know about it. So it happens automatically. You're not actually, bothered about whether the inflation is eating away or not. So the fixed income products, the risk that is associated is basically the return on income. The return on income after adjusting the taxes is basically eroding, the capital. So that is the risk that you are carrying with respect to fixed income products. Any of the fixed income products, that might be your fixed deposits or your debt mutual funds. Prior to last year budget, the fixed income products on debt mutual funds is basically providing you better tax adjusted return. Now actually, everything is bring under the tax net, all the debt products. So from that perspective, your pension plan or your annuity income, or whether you receive, even pension income or any income that you receive, is basically, taxable. So when we are talking about after tax net return, that is basically is something which will eat away your corpus. So does it mean that, you should get away from fixed income products? No. To what extent you need to have the fixed income product is something that one has to decide based on the risk appetite that they have. What is the kind of risk that they can take? Based on that, they can they can invest in the fixed income. And second is, when we are talking about gold, yes, of course, it is an asset class. One has to get invested in gold. So when we are talking about gold, gold is a hedge against inflation. So when it just provide you the return when whatever inflation rates are. When the inflation is 10%, you will get gold will be delivering you about 10% return. When the inflation is at 5%, the gold would deliver about 5% return. So from that perspective, it is a hedge against inflation, and hence gold is an asset class. But when we are talking about gold, you should not invest in ornaments. Instead, you can look out for other options. Basically, you can look at sovereign gold bond or gold ETF or something, which would reflect the gold prices, the underlying prices, or the reflection of the gold prices. So that is something that you can look at it. And thirdly, we are talking about properties. The basic problem with properties are basically, it will also provide you a huge return. But on the other side, managing property will be very difficult. And that too, when we are at the retirement stage where we may not know where we would be settling down, whether we would be moving around here, there, everywhere, or whether we wanted to settle down along with your children, or you wanted to settle down in a different city where you are located. These are the things that could probably hinder your management of properties. And thirdly, the property, the return on investments is basically is not more than 2% to 3%. When you are investing in a property which is 1 crore worth, you will be getting a rental income of about 20 to 25,000 rupees, which is hardly 2 to 3% on the return on investments will be given by the property. And hence, though it might be providing you the a return over a long period, but still management and one tenant moving out, another tenant coming in, managing the property will be very difficult task post retirement. And hence you can have one property for a living purpose and not a kind of you need to have multiple properties for a rental income. So you cannot live with the rental income. Then finally comes to the equity based investments. So when we are talking about equity based investments, so there are basically, we are talking about equity is one asset class which will provide you a kind of, the inflation adjusted return and better tax adjusted return. So this is something, that you can always look at investing in equity based asset class. See, why? Is basically when we are talking about the Indian country as a country, if you look at from the last 40, 45 years. So there are, the inflation for the last 40, 45 years is averaged out to 6%. And the GDP for the same period is averaged out to 6.2%. Adding up GDP and inflation is what the nominal GDP. So when we are talking about 12%, 12.2% is the nominal GDP. Any company which is started in India would grow with the equation of more than 12% from the overall nominal GDP. So from that perspective, equity as an asset class over a long period, I'm talking about 3 years, 5 years, 10 years, 15 years, this will be providing you about 12% CAGR. So you can expect a return of about 12% over a long period. And hence, even if you look at the taxes, the long-term capital gains on equities are taxed at 10%. Even negating the taxes, you could get about 11, 12% returns over a longer period. And hence, you need to have an allocation towards equity, an allocation towards debt, that is a fixed income, and an allocation towards gold. These are the three asset classes that you could spread your investments. So now, when we are talking about what is stopping you from investing in equity based products. So when we are talking about equity based products, it is basically everybody is not ready to willing not willing to take risk is what actually the key agenda is. Investing in equity market is subjected to market risk. So when we are talking about risk, for each and every product there is a risk associated with it, wherein equity also carries a risk on the short period of time. So when we are talking about long period, so equity based mutual funds, which are basically being managed by professionals, which will probably provide you a better risk adjusted return. The risk that is associated with this basically, we are basically, taking part of the Indian economy growth story. So when we are talking about from the morning till evening, I'll just give you a simple example. What makes us away from investing in equity is the risk. But when we are buying products, we are not actually participating buying their stocks. For example, when we are getting up in the morning, when we get up in the morning, we use toothbrush that is belonging to Colgate and the close up or whatever you call it as, that is belonging to Smith Klein Beecham or Hindustan Unilever products is what we are using it. You are after that you take a there using the soap or any that is also belonging to one of these products. Then we use the oil, sunflower refined oil, or the atta, that is all belonging to ITC and your what do you call it, your Adani Wilmar products. These are the companies that we are living with. After that, you take Hero Honda bike, or maybe you may be taking up a Maruti Suzuki car. So we invest in those products, but avoid investing in those company stocks. That is what actually is the risk that we are taking. So when we are talking about risk, we are consuming the product. On the other side, we are hesitate to invest in their company stocks. So this is where actually it is stopping our investments in terms of equity. But over a long period, always the equities are going to deliver a good return, and you should not avoid. Then when it is coming to managing the portfolio. So assuming you are at the age of 55 or you are at the age of 60, you plan your retirement portfolio. It is not something you just have to create a portfolio and then forget. So that way, it may not provide you a better return. So the portfolio needs to be, it has to be evaluated at least once in 6 months. Every 6 months, you have to sit and evaluate where we started, where we are right now, whether this portfolio is good or not. And then you have to, if any realignment is required or a rebalancing is required, that way, yes, you have to lead the portfolio to the next level. So if you don't do it, what happens when the market has rallied heavily? If you are not rebalancing your asset allocation rebalancing is a key method to create wealth over a long period of time. So assuming if somebody is investing 100 rupees in the asset allocation and then just leaving it as it is, their returns might be lower than the portfolio 100 rupees invested across asset classes and then rebalancing it over a long period. That is over a periodically, if they rebalance it, that portfolio could deliver a better return compared to the portfolio which is a static allocation. So from that perspective, you have to review your portfolio at least once in 6 months to ensure that the schemes, see, there are various things that we need to look at when we are doing the portfolio check. So what are all the things that we need to look at it? Whether the category what we have chosen was right, whether any rally that has happened to that particular category of funds. Then you have to look at whether equity market has overvalued in the last 6 months or not. If it is overvalued, what is the action that needs to be taken? If it is undervalued, what action needs to be taken? So this is something that one has to do when they are doing the review of the portfolio. So reviewing is not just an activity; it is actually an exercise one has to probably do it very systematically. Then only they will ensure that their portfolio is on track compared to this one. So assuming you have a portfolio which is consisting of more of a small cap category of funds. So if we look at it in 2017, the small cap has delivered 110% return in a 1 year period. Everybody looks at the past return. Based on that, they keep investing in the present money, whatever they wanted to invest further investments. They always look at the past return. Based on that, they take a decision. That is not the right approach. For example, 2017, the small cap has delivered 100%, 115% return in 1 year period. But we have recommended the investors to stop investing in the small cap especially, because their valuation is basically on its peak. So after one point in time, either the price correction or the time correction has to happen. So we decided not to get into small cap because it is overvalued. Exactly in 2018, the market has crashed, and then the small cap has also come back to normalization. So the consolidation phase has happened in 2018 for the small cap. So unless and until you sit and do the review of your portfolio on a periodical basis, you may be avoiding this kind of a market situation that actually probably happens to the portfolio. These are all some external factors. Other thing is, there could be some internal factors also which you have to adjust against your portfolio, assuming you decided to hold on large amount of money in equity, but for some reasons your risk appetite does not allow you to get more investments in equity. You have to realign the portfolio to ensure that you reduce your risk on your portfolio. So that is also some external factors which will probably decide about the rebalance. So this is something the rebalancing has to be done on a periodical basis. And next is when we are talking about what stops, what makes you stop investing in equity. So basically, we have few biases, where we have two minds. One is actually the right brain and the left brain, so which works completely differently. So when I put forth this question, you know, so when a ball and a bat is costing about 1,100, some of you can probably answer. Okay, a ball and a bat together cost about 1,100, whereas the bat is costing more than the bat is costing more than 1,000 rupees. What is the cost of the ball? Can anybody answer? A bat and a ball put together, it is 1,100 rupees. That is 1,100 rupees. The cost of the bat is more than 1,000 rupees. What is the cost of the ball?
You can unmute and answer. Anybody wants to answer or raise your hand? You can unmute. Come on, guys. I'm sure you can math it out.
If
Anyone?
the bat is
It will be
100,
less than 700.
Less than 700. Any other answer?
yes, I want to say
Yeah.
the bat is more than 1,000.
Yeah.
That means 1,050, and the ball is 50.
How?
Because you told it is more than 1,000, so I made it 1,050. 100 divided.
Yeah. This is actually heuristic bias. So we call this as heuristic bias. When we are talking about heuristic bias, we always jump into conclusion without doing the mathematics. So this actually she might be right with the answer, but how to get the answer? Basically, there is a mathematical equation involved. So it is not so easy to find out. You are just on the top of the mind, you do the mental mathematics and then do the calculation. That is actually wrong. So this is what we call it as heuristic bias. Always we think about the market has run up significantly high in the last 5 6 years. Everybody expect that the same thing will happen. The same thing will repeat even after 1 year, 2 years from now. Everybody expect that it will repeat, but it may not repeat. So that is heuristic bias, and there is something called as anchoring bias. So anchoring bias is nothing but the price fixation is what we call it as anchoring bias. Assuming the Sensex some time ago it was at 60,000. People used to be waiting. When it was 50,000, people used to be saying that it is too high. So they will wait for a correction. The correction did not happen. So it went up to 60,000. They feel, when talking about 50,000 Sensex was high, when it is moving to 60,000, then also they feel high and they will wait for the market to correct. When it goes to 70,000, that time, it is actually, the FEMO effect. That is, what is called as fear of missing out. So the FOMO effect will come into picture, and they will again, what they do is they will just start jumping into the market. So that is the peak time where whatever the time that they have invested, from there onwards, probably the market will start coming down. Then they feel like they are not lucky enough. So they will wait for the market, it will probably come back. So 70,000 maybe coming back to 60, and then it will come back to 50. They will pull out the money. If they repeat this, every time, they are not actually going to create wealth. So these are all the biases which are actually stopping the investors to invest in equity market, wherein if they really identify the asset allocation and then do the asset allocation periodically, rebalancing it, and then ensure that whatever the corpus that is, even see, basically they have to identify what is required for them, and based on that they need to take a wise decision on investing in various asset classes and do the periodical rebalancing, would ensure that they will reach their financial goals well ahead of their time. And the seventh wonder of the world, what we call it as SIP and SWP. SIP is something where it's the methodological investments which will probably help them in creating assets for their for their goals, whatever the goals they may have. When somebody is at 50, they can probably create an SIP to ensure that they reach out their retirement well ahead of time. And after 60, they need to do a kind of pension plan. So sorry, they need to withdraw a pension. So to withdraw a pension, they can use a systematic withdrawal plan. So the systematic withdrawal plan will help the investor to basically avoid paying more taxes, because when you are doing the systematic withdrawal plan, you will be withdrawing a portion of capital and portion of profit, which will probably eliminate paying more taxes towards the other products. Even some might be investing in a product which is delivering 10% return on a year basis, up to 1 crore of a withdrawal, they will not be able to, they need not have to pay taxes. So from that perspective, SWP is something which is the better, methodology of withdrawing, money for their retirement. So ideally, what is the percentage of, the withdrawal that they can expect? Is basically they can work between somewhere between 8 to 9% of yearly withdrawal, would safeguard the principal, as well as they can start enjoying the benefit of withdrawing the money over a long period. Though the capital during the initial point in time may be eroding, whereas this the corpus after 5 years or 10 years, that will grow in multiples, which is more than your capital. So basically, now assuming somebody is investing in a kind of a hybrid fund, assuming 10 lakhs is being invested for a period of 10 years, if they keep withdrawing 8% withdrawal, they could definitely have or this 10 lakhs would have probably become 20 lakhs, and they could have probably withdrawn 8%, 80,000 rupees for the next 10 years is about 8 lakhs. So this way, you can work on basically managing your corpus, and at the same time do the periodical rebalancing, and thirdly systematic withdrawal plan to enjoy a minimal tax kind of payout that you can do it to enjoy your retirement is something that we always suggest. That will be something which we would recommend to everyone. Then finally, when we are talking about identifying the product, basically we have to look at four things. One is actually we call it as SL or S. So basically, what we call it as safety, then liquidity, then returns, and then suitability. So first and foremost, safety is important. So whether it is safe to invest, we have to identify what is the safety of my investments. There are plenty of products available where it is not providing any safety at all, wherein we have to look at whether it is safe, whether it is regulated product, whether it is being regulated by SEBI or regulated by RBI or regulated by some authorities. That is something that we need to look at it. Second is liquidity. When I invest now, when can I get my money back? Assuming I am investing tomorrow, I need the money to be withdrawn. What is the liquidation period? Whether it is 1 day, 1 week, 1 month, or 1 year, or 5 years, what is the liquidity? Based on that, one has to take a decision. That again depends on the goals that you have. And finally, only you have to look at the return. So when your goals are, shorter, you should not look at higher returns. Always, there are plenty of Ponzi schemes that are available in the market, which will be delivering you higher returns. But here you have to look at the safety of principal. Nobody knows. Safety of interest, nobody knows. And liquidity, nobody knows. Whereas only, expecting the return alone is the criteria, then you should not choose the product which is providing you very huge return. And finally, whether all these things are there or not, whether the product is suitable to me or not, something is, that is something that you need to check before taking the investment decision. If you do all these things, there is no question of, you miss out the bus in terms of making your retirement in a peaceful and successful way. So with this, I'm, stopping my conversation. Now I'm open for any questions.
Yeah, anybody has any questions, either raise your hand or you can also put it on the chat. We can have it quite interactive. Anybody would like to ask anything? Put it on the chat in case you don't want to speak out. Anyone? Did you all understand all what Mr. Sridharan has said, or is there anything that you would like him to repeat? Okay, so let me take the questions that we already have with us, where people have asked. Okay, so Mr. Sridharan, what is the difference between a pension plan and regular income plan?
The regular income plan and pension plan. See, the pension plan is something, where you get a defined, amount which will be given to you at a periodical manner. So this is pension plan is something, which might be offered from insurance companies. They will be offering the pension plan. Most of the pension plans will be offered by insurance companies. where you know lock in your money, and then there are options available, and then you start getting the pension. A regular income is nothing but it may come from different sources. Might be, you could have probably invested in fixed income products which will provide you, assuming, if you invested in bond, they will be giving you a coupon rate which is a regular income. If you invest in property, which will probably provide you a kind of a rental income, which is a regular income. And if you invest in mutual funds and then start getting the systematic withdrawal, which is a regular income. So the regular income is something where we decide how much we want, and based on that we invest in various product. Here, this will be fixed by the pension. The pension in the sense, the insurance companies, they will decide how much they will.
Okay. The next one, with frequent reviews of one's portfolio, is there any risk of quitting a stock too soon?
No, I did not get your question.
So with frequent reviews, like you said, we need to keep reviewing our portfolio, right? Like,
Correct.
is there a risk of quitting a stock too soon, like probably selling it out too soon, thinking that, okay, it's gone pretty high?
Yeah. See, basically, we don't recommend always a quit option or a redemption. We just do the checkup. See, assuming we do a regular health checkup, does it mean that the doctor always advise you to go for operations every time you do the regular checkup? No. We see what is the health of the portfolio, whether it requires any changes. If it does not require any changes, it just goes as it is. But it requires a checkup.
Sorry, I didn't get that last. What did you say? It requires a?
It requires a regular checkup.
Okay, fine. Okay. What is safer and better, mutual funds or FDs? And in what ratio, if you want to choose both?
Okay. See, basically between the asset classes, one is equity and another is fixed income. The FDs, more than FDs, there are a lot of other competitive products like, for a senior citizens available, senior citizen saving schemes where 30 lakhs of limit is available, where we are offering 8.2% returns, which is not being offered by FD. But overall fixed income, after let us say, the retirees, the overall fixed income could be about 60%. So overall, the asset allocation, 60 to 70% in fixed income, and about 30 to 40% they can have, equity based mutual funds is something that they can explore with. You have to unmute, I think.
Sorry, should we buy gold these days?
Gold is an asset class one can buy, but on the overall allocation, not more than 10% of their money can be invested in gold. So when equity does well, gold doesn't do well, and vice versa.
Okay. If heuristic and anchoring bias are not suitable, which bias should we keep in mind?
No, these are the biases, everybody has. To avoid these biases, heuristic biases is nothing but, they will all be, you know, they will all be, doing a mental mathematics, assuming they could have thought that, this product might be suitable for this purpose. This product is suitable for this purpose. They all do the mental mathematics. Instead of that, they need to have the real plan in place. And based on that, they need to take a decision instead of doing a mental math. We are all, heavily loaded with the mental mathematics and finding a shortcut to the problem rather than get deep into the problem and identifying the root cause of the problem and solving it is something that one has to look at it. I'm not saying they should not have the bias. They need to have the bias, but they need to identify the solution to the bias that they have. The heuristic bias is nothing but, when I give a problem, they are just looking out the solution immediately and finding out the shortcut. When somebody is, recommending this stock is doing well, they will all look at the news and buy the stock. They don't know the fundamental of the stock. See, somebody is talking about, today, CNBC, somebody is coming and talking about for the next few days, in the Hindustan Unilever stock will be moving this much high. Based on the news, they will go and buy. They don't understand what is Hindustan Unilever. I'll tell you an example. In 2021, when the COVID was peak, when oxygen supply was the demand. The demand was oxygen, and there is a company called Oxygen. This company does not deal with oxygen cylinder. Okay, everybody was looking out for the keyword oxygen. This company was an NBFC, non-banking financial services. They are lending loans, they are giving loans, and then this one, their stock went up by, almost like doubling in 3 or 4 months itself. Because of the name, it has just got Oxygen. That is the kind of, heuristic bias everybody has. And they just look at the shortcut to the find something oxygen. If you look at it, you just go invest. So this is the bias everybody has. So they have to identify why they are investing before they just invest into any stocks or mutual funds or any product for that, no matter what the product it might be. That is what the heuristic bias has to be removed instead of this.
Yeah. How do you know the Sensex is going for correction? In other words, what makes equity overpriced or underpriced? Any logical reason to consider, or is it just gut feeling?
It is not gut feeling. See, basically, when we are looking at it, we are paying a premium for whatever that we are doing. We are, basically, that stock is supposed to sell at 100 rupees. Now it is selling at 150 rupees. And the company might be growing at only 20% every year. So that means 2.5 years pricing is what we are buying at right now. So 2.5 years, yes, of course, either the company growth has to improve between 25% to, if the company is growing at 20%, it has to grow by 30%. Is there a possibility? If there is a possibility, the stock price will move up faster. And if it is not the case, this is where the company, the progressing from the last 10 years and the expected growth is only 20%. So that means you are paying a price of, 2.5 years time price today. You cannot expect any growth in the next 2.5 years unless and until there is some sentimental value, somebody is keep buying that stock. You are buying and waiting for 2.5 years. After that only you can expect the growth. This happens to across all companies, across all products. So assuming, you buy a house, which is 1 crore worth today, might be growing at 10% every year. So if you are buying at 1 crore 50 lakhs, for the next 5 years, you cannot expect any return on investments. Is that the fact? Same thing is applicable for equity also. Whether the small cap, at what price we are buying, and whether we call this as price to earning ratio, P. P multiples is what actually decides whether the price is overvalued or undervalued. If it is undervalued, then we can buy more. If it is overvalued, we should buy less and wait for the market to correct. So from that perspective, the small cap is basically, overvalued at this juncture. If there is a growth potential, then probably, it will grow faster. But we have to wait a bit.
How do you calculate the growth potential? Is it you just
In the
yeah.
The growth potential, no, I don't get your
So
question.
you said if the company has grown only 20%, then it's not very this thing. So how do you calculate like how much it's
There
going?
is a, yeah, there is a methodology for each and every. There is a PE multiples is something, which will be used for measuring the future growth of the future growth of the Sensex. See, basically, when we are talking about Sensex P is what something that we look at it. So when the P of the Sensex is higher, then probably either the time correction or the value correction that happens. Time correction is it just stays in whatever level it is right now. It stays for next 1-2 years.
Mhm.
So the investor may not get any return. And there could be, sometimes what happens is this level, it comes to, maybe 10%, 15% correction. Then probably again it will. So that is value correction. Either the price correction or a value correction used to happen.
Right. So when should the PPF money be withdrawn? Should it be withdrawn only in emergency?
PPF money, one can stay invested for the 15-year period and then they can withdraw it. Because PPF is the only investments that is providing a tax-free return. So from that perspective, one has to stay invested 15 years. If they are nearing the retirement, then they can probably withdraw. If they are not nearing the retirement, if they don't require the money, they can even, consider expanding their tenure for the next 5 years long. Every 5 years, you can extend that for another 5 years. So PPF is something that they can hold on for a longer period from a fixed income investments.
Okay. Is nominee compulsory in mutual fund, etc.? What about those who have no one?
Okay, see, when it is nominee is compulsory because nominee has the authority to get the money when the investor has when the investor is deceased. So nominee has the rights to transmit the assets from the owner to the nominee. If there is no nominee, then the money will be given to the trust, and they can nominate anybody. Even they can nominate their friends or relatives or some trust or some society or anything they can nominate. So if they nominate somebody, they have the right to claim the assets on behalf of the deceased one.
Okay. When can we liquidate shares?
It depends on whether they are reaching their financial goals. Yes, that is the time they can liquidate their stocks.
Okay. How much should you invest in different investment plans like mutual fund, shares, FD, etc.?
Okay, so this is I've already suggested the fixed income in the sense all your fixed deposits or senior citizen saving schemes or your other bonds and other things put together, they can have about 60% of their assets in fixed income, and 30% to 40% they can have it in equity based product, be it direct equity or mutual funds, and maybe about 10% of their assets they can invest in gold.
So gold, you would suggest 10%.
Yes.
Okay. Last question for today. Fixed deposits are safe, but their interests are low, and even those that interest is also taxed. Suggest alternative safe sources of income.
Other safe sources of income compared to fixed deposits are, since if they are retired, they can look at senior citizen saving schemes where there is a limitation of 30 lakhs, and they can also look at the government bonds and corporate bonds, or maybe they can look at the debt mutual funds which are investing in the government bonds and corporate bonds, basically with the duration of 3+ years, which could possibly deliver about a decent lower double digit return, maybe about 9% or 10%. 10% return is something that they can expect because of the interest rate cycles are going to be reversed. So when the interest rate cycles are reversing, then probably the corporate bonds and the government bonds would deliver a better.
And last question, how much money should I aim to have in my emergency fund relative to my monthly expense?
See, basically, when we are talking about the retirement, post-retirement, I would say about they need to have at least, 10 to 15 lakhs as an emergency fund. Okay, this is required for because some emergency or anything may happen any point in time. They need to have 10 to 15 lakhs as a kind of emergency fund. This is required only for hospitals or any kind of travel, sudden travel or something. For that they can have it. Apart from that, they can have overall, assuming they have if they need a corpus of let's say about 2 crores for their retirement, they need to have at least 10% of their money as emergency expenses.
Okay. All right. I think we are done. We've taken all the questions. So thank you so much. Sorry, somebody
Thanks.
wants to...
Can I ask a question?
Yes, please go ahead.
Yeah, my name is Dr. Shashi Bhushan. What I'm saying, you're talking about retirement funds and about the retirement, and as Sridharan has explained, every 6 months you need to review how the portfolio, how to change it. The point I'm asking is that it's too technical for me, whole of the life who is doing medical practice, to look into it, how the mutual fund, which is diversified, they invest in different companies, to go through the companies, which company is doing what, and then it is overpriced or underpriced. How practical it is, if you look at from my point of view, to know all this, number one. And number two is that, so the person you are certainly doing day in and out whole thing is a full-time job. But ours is not a full-time job like this, even though we are retired. How we will able to give some hint that, after 6 months when you're reviewing it, and then you should know, well, I'm doing right way or wrong. I need to transfer the funds to different funds. What is the, in short, how we can go ahead thinking that I'm a complete layman regarding the Sensex, regarding the stocks, regarding mutual funds?
Very, very nice question. That is the reason why you need to, sign up with a financial advisor.
I know.
Basically,
Yes.
see, being a doctor, if somebody is not well, if it is a cold or cough, they can just go and buy medicines in the nearby medical shop and then take it. If there is some complex diseases, they have to go to a doctor, visit a doctor, and take the advice from the doctor and do the that is what actually I've been advising everybody.
But
we are
the doctors
like
also
a
do
financial
wrong
doctor.
sometimes, no?
That is actually something where you have to look at the credential and credibility of the doctor. See, basically the doctors and the hospitals they have to create the trust. First and foremost, we are all looking at who is a good doctor, and then look at their profile and what have they done and what is their qualification. For some specialty, this one, for heart surgeon, we may not go to a ophthalmologist. So they have done this, professional courses in each and every area of specification. So in that also, there are experiences that talks actually. So we have to shortlist, finalize, then they have to choose them as an advisor.
Thank you so much, Mr. Sridharan, and thank you all of you for joining
Before you
us.
leave, what is the price of the cricket ball?
50 rupees.
Okay.
Thank you.